everything's built upon the last thing. So you want to make sure that you are, you've already watched, or that you're watching, right, these other other sessions. Okay, very important. Now, man, I just haven't been able to find my way onto this train. Looking at the market. Once I missed my my ride the other day, I've been waiting for a pullback. I just have not got it yet. Excuse me. All right. And we just been running. Last night, I was like the best pullback I had. But that's it. Okay. So remember from the other day, right? We talked about wave structure. Okay. And this is one of the biggest things. So remember, ORS is really about finding the optimal reversal approach, right? Where is that at? Well, my argument is that when markets go, they move in waves. And so my argument is we don't really want to worry about this. We want to worry about this. This is what we want. We're going to let them go first. And then from there, we're going to take advantage of it, of the next move, okay? Of the next move. So we describe, I did it. We describe that as the call, okay? That initial impulse, that correction, we describe it as the call, okay? We describe it as the call. Now, one of the things that you're going to see here is that we have a really great partner. Okay, we got like a best friend that makes this that really completes this and brings this all together. Okay, it is Fibonacci. Okay, it is Fibonacci, and Fibonacci is like ORS's best friend. Okay, ORS's best friend. Now, what I want you to understand about it is essentially the market makes impulses and it makes corrections. Okay. Now, what we do is, here's the call, but we have to listen to the call, okay? So that we know how to respond. And this is the key. We have to listen to the call so we know how to respond. And how do we listen to the call? We listen to the call with Fibonacci, okay? Fibonacci is how we actually listen to the call. Now, this is a Fibonacci tool right here, okay? And basically, it's going to tell us how to respond, okay? It's going to tell us how to respond and what we're going to do next. Now, I'm not going to get into like, you know, what is Fibonacci, all that stuff. I teach a series called Fibonacci Made Easy, okay? It's going to expound and go deeper and further than what you're initially exposed to in the course. Okay. Between the course and Fibonacci Made Easy, you're going to be in a solid place, but you also will get it here. But I'm not going to go into like the background, you know, X, Y, Z. What we're going to do is we're just going to focus in on how we utilize it. Okay. How we utilize it. Now, ultimately, what happens here, remember we said we're listening to call. What happens here is you have the impulse, but then you have the correction. And depending upon how far the market corrects, it's going to tell us what the response is that's next. Because we don't necessarily just want any pullback, right? There's ones that we prefer, and I encourage you to kind of find your preference and stick to it, right? You don't have to take every call. Just like you don't have to answer your phone every time someone calls it. You don't have to take every call in the market. And I think that's important to understand, is that we don't need to take every call, okay? But we need to be listening for the one that we want, right? And we'll respond. So basically, there are different Fibonacci levels, okay? And excuse me. Now, imagine this is 0 and this is 100, okay? Well, if we go 100% and we turn around, right? Turn around. I probably should do it this way. Imagine just for the sake of this, okay? This is 100%, the distance between here, okay? Now, here we've gone, this really is 100. It is 100, but this is 100%. Now, if we turn around here and come around, we're coming back. We come back 2%, 5%, 10%, 15%, right? 30%, 50%, 80%, right? 90%, and we come back 100%. Okay. If you go all the way back to the beginning, that's 100% turnaround or retracement. Now, what happens is there are main areas, right? So some of the main areas that we're looking for the 23.8, right? 38.2. These are going to be shallow retracement levels, okay? These are shallow. Now, as we move forward, right, we have more normal retracement levels, normal markets. Now, shallow means you have a very strong trend. The market has a strong trend. 50 is about normal. 50 is like life, right? Where you move maybe 2 steps forward and 1 step back, right? That's life. Okay. This is a little bit more normal. 50% is in the normal type of ways that the market retraces. Okay. Normal. Now, 61.8, also normal. Both of these are in the normal. However, the trend is the strongest at 23.8, then 38.2, 50%, and 61.8. So 61.8 is going to be a weaker trend, but it's still normal. It's normal. So we went 2 steps forward, and then we came 0.3 steps back. right? It's normal, right? It's still within the realm of the average scenario. Okay. Now, the next area is the 786. Now, the 786, this is basically, we didn't go 100%, but man, we almost got back to the beginning. Okay. This is a deep retracement. So we have shallow retracement, normal retracement, and deep retracement. Okay. Deep retracement. Deep retracement. And then 100%, that for sure is a range. The market is in a range. It's 100% and it's consolidating. So a lot of times you'll see it go up, come back, right? When it starts doing this type of stuff, that's that 100%. And the market is it's in a range. Okay. It's in a range. And so this right here tells us information, right? So this is how we listen in to the call. This is how we listen into the call to know if we even want to respond. You know how like, there's some people, they let the answer machine come on, right? They let that answer machine come on when people call so they could hear who's actually calling, right? They don't pick up the phone, they just put the answer machine on. It's like, hey, Bobby, this is Chuck. I was just calling you about that car you have for sale. And then they come over, hey, Bobby, hey, what's going on? Or hey, Chuck, what's going on, right? They'll answer the phone because they're liking what they're hearing. If they don't like, hey, Bobby, this is the 10th time we've called, right? Pay us our money, Bobby, right? That right there, they're not answering that, right? They're not going to answer that call, not on the 10th time, right? By now, right, they're avoiding the call. And this is how this works. You don't have to answer every call. You could let that answering machine come on first. And then from there, right, you can pick, right? Some people only like to take the trades when it's in the normal ranges. Some people actually do like deeper retracement, right? Some people only want the shallow retracement. But you don't have to answer the call, okay? Don't have to answer the call. Type that in the chat. I don't have to answer every call. I don't have to answer every call, okay? 23.8, 38.2, 50%, 61.8, 7.86, 100. These are going to be the standard retracement levels. And these are going to be the levels that we focus in on. Okay. Now, anything that is above the 50 to 61.8 range, we're going to consider this as anything 61.8 and above, we're going to consider this as continuation levels. Okay. Continuation levels. Anything that is below that, we're going to consider these as consolidation levels. And I'll explain what I mean by that. Okay. Let me come over here. What's up, Ann out of Trinidad? I don't have to answer every call. No, we don't have to answer every call. Okay. So we have it here. When the market pushes up, all right, here's our push up. Okay. We're coming back. Well, what we would do is we'd have Fibonacci from here to here. Now, this right here, 61.8 and above, this is going to be considered our continuation range. Okay. Our continuation range. Now, what do I mean? Well, after the market reaches these areas, okay, reaches these areas, Continuation simply means we should make at least the equal high or make a higher high, right? That's what we're saying. If you hit here, 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 or here, we're expecting the market to move higher than here, or at least to the same exact level, okay? This would be our continuation area. Now, our consolidation area would be basically in here, okay? In here. Now, it could be a little lower, but the point is 786 to 100%. This is going to be more of our consolidation levels, meaning there's a chance that when the market comes here, our expectation isn't automatically that it's going to make a new high. Typically, the next impulse will stay within the high and the low of the range. So if this is our low and this is our high, it will typically produce a lower high on the next impulse. Now, doesn't mean it'll never get out. No, especially if this is a 2, it will get out. But a lot of times the way that it does it is it will have to do something like this and then do something like this and then do something like that. Like, it doesn't usually make that pretty exit, right? Many of us, when you say, oh, I was in that trade, it was like, I didn't really enjoy it, right? I didn't really enjoy being in that. It kind of pulled back on me and just I was in drop. Like, a lot of that is because we're answering calls, right, that we don't have to, okay? I ideally like to answer the call when it only retraces to the 61.8 or above, okay? And preferably between 38.2 and 61.8, okay? 23.6, I will answer it, but I'm a little bit more hesitant, okay? But 23.6, those are there. Why am I hesitant? Because markets typically retrace to 38.2. And it's usually because I'm looking for that, I miss out on the 23.6. Those very, very shallow, aggressive trends are the ones I really, really miss, right? I really, really miss. So again, recapping this, these are consolidation ranges where we don't expect the next level, right, to be broken. We expect it to stay within. It doesn't mean it won't. But our first objective is if we're going to take a trade, we're going to look for a trade within the boundaries, within the range, okay? But if it lands in a continuation level, then we're expecting it to move beyond the range and move further out, okay? And this is important to understand, okay? This is important to understand. The difference between consolidation and continuation. Now, this section right here is a special zone for me. And that's why you can see my colors are different here. I call this the gold zone, okay? The 61.8 is what you call the golden Fibonacci level, golden ratio. But for me, the gold zone is the 50 to 61.8 level. Okay, this is the gold zone. That's why you see it this color. Now, I have another zone called the ruby zone. And it's the 786 to the 886. So I didn't give you that number earlier, but I'm going to give it to you now. Okay, 786 to 886 is what I call the ruby zone. Okay, so you got the 50% to 61.8, and you got the 786 to 886, which is the ruby. So gold is 50 to 61.8, ruby 78.6 to 88.6. Okay. And so when the market pulls down to the ruby or pulls back to the ruby, that's typically meaning that it's not a very strong trend. Well, it does mean it. And it means that typically that next move is going to stay within the high and the low, stay within the range. Doesn't mean it won't break out eventually, but a lot of times that's there. Now, Ruby zones, if you happen to take those, a lot of times the Ruby zones, if it is the beginning of the trend, like if it's a 2, those are going to have the greatest, a lot of times, rewards because of how far it could potentially go. So I know I don't usually take rubies. I mean, I'll take them, but I don't look to take them outside of the area. If they do get out, they're typically the strongest, the most reward, right? Now, from a very basic standpoint, okay, if you take a trade anywhere between the gold zone and above, you can actually just place your stop loss at the 83.5. And the 83.5 is this orange line that you guys see on my chart. So now we've just went through all of my Fibonacci levels, and I'm going to repeat them real quick and you can see. So in my settings, we'll turn this off for now because I don't really focus on it. In my settings, we have 0%. Now where you put these doesn't matter, right? So you don't have to put them in the exact spaces. You can put them anywhere, plug them anywhere, and it will be fine. You can have all your numbers going right down here, or all your numbers going here, or some down here at the bottom. Like, it doesn't matter. These, if you have these numbers in here in any order or any place, you'll have the right numbers. So 0%, 23.6, 38.2, 50%, 61.8, 78.6, right? 88.6, 83.5, and 1. Okay. My 50 and 61.8 are of a yellow or goldish type of color. And then my 786 is of that, I don't know, pinkish, rubyish, whatever. Not really ruby, but you get my drift. All right. And then I have my 83.5 orange. Now the colors don't matter. Everything else is white necessarily, but for me, it's a visual representation of what I'm looking for. Okay. Once you have your template, I like to have my numbers on my percentages and numbers on the right. Right. I don't need the percent. So I actually show values, but you can put percent there. Right. I just have values and I like to put them on the right side. And I like to extend, right? So I like to extend my lines. So I don't have to pull it over. It always just sits. I like to extend it to the right, so I could always see it in my future. Okay. And I also like to have my trend line on. Okay. So this is it. Okay. This is it. So let's let me make sure. Okay. So just checking my notes, but basically you can have your favorites. Okay. And this is where, like I said, you can make a decision to answer the phone or not. Okay. So you'll have statements like, I need the market to come back to my goal zone before I participate. Right. Everything else, right? Everything else, that's somebody else's money. I'm just gonna leave it alone. Right? This is what I need. Right? So fibs can help us establish rules. and give us rules or boundaries, right, on how we're going to participate. Okay. That's the key. That's the key. Now, if you take a trade off the gold zone or above, 83.5 could be your stop loss. If you take a trade off of the ruby zone, the stop loss would be the 1. Okay. So if you wanted to just take trades like and not really worry about like your entries, or if you're like a pending order person and you're kind of predicting, right? These are going to be great places to place your stop loss. Okay. Let me come down here and kind of show you. So let's hide all this. Okay. Now look right here. Check this out. Right here, we had the beginning of the call. We had the impulse. We haven't had the correction. So imagine, right, you see everything's changed, right? The structure has changed, right? We're no longer making higher highs and higher lows, right? We've shifted and we've made an impulsive move down, okay? So this impulsive move down, remember, it's a part of the call. But now we're looking for the response. Now the response is going to happen. The rest of the call is going to happen with the retracement. But the question is, where would the market be retracing to? Where are some of the areas? Like right here, I can see that this is an area of resistance, right? I can also see that this area right here is an area of previous support. Okay. So imagine I was looking for a retracement. Now the market hasn't retraced yet, but imagine I was. Well, if the market stops in the gold zone, what could I do? Right? I could actually short the market here in the gold zone and put my stop loss right here. And then I would be looking to take it at least to the back to here or to the next area of structure. Okay. Now, for some of you guys, like, that's all we have to do, right? We don't necessarily have to be there for the perfect entry, right? We're taking our knowledge of how the market typically moves and we're leveraging it. Now, if the market only goes to the 38.2, where could the stop loss be? Still the 83.5. Now, obviously, if it only goes to 32, then it's not going to go to any higher. But I'm basically trying to say, if you take a continuation level, the 83.5 would be a great stop loss. Okay, so anywhere in here, okay, we're gonna go for this 50%. Okay, 50%. So we have it here. Here the market is retracing back. We're in this trade. 83.5 would be our stop loss. And now we'd be out, right? We'd be out. That right there is a call you want to answer, right? A call you want to answer. Why? Because it's landed in our gold zone. Gold zone is saying we're most likely going to move lower, right? Lower. And it could go even lower, right? As we could see. Especially, remember what we talked about, if this wave here, the market likes to go an equal distance, but also further, right? So the distance here The market loves to go this same distance in here, but it also likes to go further, right? Further than that. So it usually likes to go at least equal, but it's typically going to go further. Okay. So this is something that when you see it happen, it could be your best friend. Let's look at some more examples. Okay. This right here. This is fantastic. All right. So notice that the market made a push down right here. Okay. Push down. Well, notice how this retracement has gone beyond our continuation level, almost to the ruby, but not quite, but beyond. And notice that when the market came, we went down and we came back, notice that the next move didn't take us outside of the range. It had us stay inside. And this is what I mean. When the retracement is deeper than our gold zone, then you don't want to be targeting things that are outside of the range. You want to be looking for destinations that are in. Why? Because it could go, but a lot of times it's a consolidation level. Okay. And it takes a second for it to get on out. Okay. And this went up again, and then eventually we got out of there. But this right here is you got to watch out for that. Okay. Got to watch out for that. What else do we got? I mean, it's happening all over the place. We can see right here, right? The market made a push up. Okay. Where did it eventually hit? It stayed above our gold zone. So as long as it's staying above our gold zone, what's the expectation? That it's going to move higher. And remember, it likes to go, especially if it's a gold zone, it likes to go at least the same distance, right? At least the same distance. So that right there, great take profit right in here. But we can say at least, so now we can project over here that the market should go beyond that level, right? Beyond that level, which would take us, somewhere else. Okay. And, the cool thing about Fibonacci is once you start to use it, you'll start to see that it's just all over the chart. And so even here, because this hit the 38.2, we're going to go at least, like I said, the same distance as this, right? Typically. Okay. Typically. And you can see, this is a destination that the market typically likes to get up to, right? Typically. Try to find the balance of needing to trade and wanting to sleep. Because after I get off with you guys, I need to trade, but I want to sleep. I'm gonna see if there's a more intraday setup I could just take advantage of and go on about my business and get some sleep. Honestly don't feel like waiting for my entries right now. Let's just go with an overall approach this morning. Okay. Now we're going to learn on Thursday, right? This approach, right, of okay, now that I hear, right, now that I hear
guys,
this,
welcome to you. In this video, we are going to
this
see
move,
how to download
what
and
is it
install
that I
Chrome
am
AI in Windows 11 PC or laptop. It is a very
gonna
easy
do now?
and
How am I
simple
gonna
process.
respond? And we'll
So
talk
let's go to
about
our video. First, go to
the
any web
response
browser that will.
more. Excuse me, y'all. We'll talk about the response more. But what I want you guys to see is this impulse, this correction. Now, what I'm going to do is I'm going to bring in, I'm going to bring in our moving averages, because one of the things I want you to see is someone says, well, how do I know in the market impulse? Well, one of the things about an impulse is you'll see the 2050 will cross and it will change directions, right? Typically your 2050 is a guide that when it's changing directions, right? So your 2050 is going to be one of your biggest indications that you are in the impulse. Now, what about the correction? Well, the correction, in order to correct, you're typically going to get the 4 crossing the 20. So if we look in here, we can see that here the 4 crossed below the 20. This is a sign that I'm in a correction. Okay. So we can see here, here's our impulse and here's our correction. This didn't even hit the 23.6. So once this was over, right, was this going to go up to the equal high? Of course it was, right? It was going to go higher. It was going to go higher. And you can see once that retracement was over, it responded and went up. Okay. Let's look at some more examples. Now, when I get into the triangle defense, we'll have a more systematic approach to this. But you can see in here how overall this 20 and this 50 are playing a huge part. Okay. All right. Look right here. Here's our 20-50 cross down, right? 20 below the 50 is a sell. Now, what do we have here? A 4 crossing above the 20. So if we see that 4 cross above the 20, now we can draw our Fibonacci. And once we draw it, we're waiting to see, right, where are you going to finish, right? What are you going to say on my answering machine? Oh, you're saying 61.8. Okay, perfect. Now I'm looking to sell you down if you come back. And I know that you should be able to make it back to at least, right, the 100%, or you might go to another level that's below, right? To another level that's below. Right? But that initial push, right, was what got us here. Okay. 420 is going to be that moment when the market is retracing. Okay, that 420 is a big deal. All right, look right here. Here's the impulsive move down, and here's the 4 crossing the 20. So your 4 crossing your 20 can be your heads up. Okay, now I need to pay attention. Where are we at? Okay, 38.2. So what am I expecting? I'm expecting once this retracement is over for it to continue down. And that's what we see, right? It came down. You get the 420 cross. The 420 cross is our sign that the market is pulling back. Okay, is our sign. When that 4 doesn't cross, you're still trending. But when you get the 420, you're now in that retracement. Okay, you're now in that retracement. Your 420 is a great heads up of the retracement. Look here. Here's our push up. Here's our 420. Okay. Now we could draw our Fibonacci. Boom. Where are we landing? 23.6. What's the expectation when it comes back? We should be able to go make a higher high. Or in this case, we go much, much further. Okay. But that 420 cross is going to be key. Okay. Right here, we're chilling. And then right here, 4 across the 20. Now it's time to do our thing. 23.6. What's the expectation? We're going to keep going. So once we got the pillars back over here, right over here, we should keep going. And that's what we did. Right? That's what we did. Now I want you to notice, right? And this is we'll get into this. We haven't talked about entries, right? But I want you to notice that one of the things is you never want to enter when the 4 and 20 relationship is off. You also don't want to enter when the 4 and 50 relationship is off. So right here, when the 420, this is when I'm chilling. This is when I'm preparing myself. I'm getting ready, right? 4, we lost the 50. I'm chilling, right? 20 below the 50. Oh man, I'm really chilling. But once that 4 got back above the 20 and above the 50, this is where it's time to participate. This is where I look for entries. So once we did that and we closed back above in here, that's go time. That's go time, right? And this is a part of why ORS is special, because it's going to keep us out of those scenarios for the most part where we are entering and the market is not ready. Okay. For the most part, I'm not trying to say it's drawdown proof, right? You can have drawdown, especially depending upon what calls you answer. Remember, I told you don't got to answer every call. So it's on you. It's on you on what calls you answer. But this is a great call. We already know it's 23.6% is a very strong trend. No wonder this right here pushed up like that, right? It's very strong trend. And this right here we're gonna really talk about that entry and making sure that we're entering when the momentum is there, when everything is there. Okay. And you can just see it over time and time again, right? It doesn't matter. It shows up in different ways, but it's the same play, right? Impulse up, right? Here's the pullback. What are we going to do? We're going to let the call, let them get them. They're coming in right here. Here's the call. Right now we know we need to be drawing our fib retracement. Look, they finished around the 38.2. What's the expectation? Now we're going to move higher. Right? And we definitely did. We definitely did. Okay. So next week we will We not next week, but on Thursday, next class, we're going to continue. We're going to continue with this. Okay, we're going to continue this show. All right, we're gonna talk about now. Okay, once we heard what they want, now what are we gonna do when we answer that phone and say hello? Right. This is how we're going to respond. Right. And the bill collector call. They like pay me my money. No, you pay me my money, right? That's how you talk to the market now. You pay me my money, right? I'm here. We're gonna figure out how we're going to. What are we gonna say? How are we gonna respond? How are we gonna get those profits that come from that initial information that we're getting, right? It was somebody else's money. Now this is my money, right? This is mine. Right? And how do we go get what is ours? Okay. What were those values again? You guys could take a screenshot. 0, 23.6, 38.2, 50%, 61.8, 78.6, 88.3, 83.5, 88.6, and 1. All right. I appreciate you guys being here today. Sorry about my weariness, but I'm gonna go take a nap. I think I am. I'm gonna try to find check the market.